All right, so let's get started, guys. Great to see you all here today or tonight for the Americans. So today we're going to be looking at a 5-step blueprint to options trading success. So let's get started. But just firstly, just to confirm, you're in the right place if you want to learn how to trade profitably and recession-proof your family. Could be very, very important going into 2019. Could be a tough year for buy and hold investors, so that's where options can really help in terms of being able to make money in up, down, and sideways markets. You're looking to build serious wealth over time. This is not a get-rich scheme. There's a lot of people out there who sort of promote that sort of thing. Binary options, stay away from those. Anyone who promises sort of 5% a month and that sort of thing, that's not really what we're about. It's a little bit unrealistic, to be honest. And if you think about it, 5% a month equates to about 60% a year. And if anyone can achieve those returns, they're doing better than probably 99% of the hedge funds out there who are sort of, seriously smart guys with a lot of capital. So, you've got to be realistic. It's a slow process. It's definitely not a get rich quick scheme. If you're emotionally stable enough to weather the ups and downs of becoming a trader, so that's important as well. It's not all sunshine and rainbows sometimes with trading. We do have drawdowns from time to time. And, particularly in the last couple of months, there's been a lot of volatility. It's been a tough period for a lot of people. So also people who don't want to spend all day in front of the monitors because you want freedom to do more of what you love. So the way I trade, I'm based in Melbourne, so it's very difficult with the time zone. I think at the moment markets are open from about 1:30 in the morning till 8 a.m. So I can't be in front of the screens all the time. I like to get some sleep. So the way I trade these days is a little bit more slower paced. It's more longer term trades, and I'm not day trading. I'm typically maybe trading or making an adjustment maybe once a week. So that's really ideal for me. It kind of suits my lifestyle. If you're ready to invest in yourself to become a consistently profitable trader, which you guys are here today, for everyone who's here live, I have no doubt that you're committed, and I don't think that'll be a problem for you guys as well. And if you're looking for a step-by-step system that is proven to work. All right, so what are we going to cover today? So the 5-step blueprint, we're going to go through avoiding the 2 biggest mistakes, how to use probabilities in your favor, learning to use volatility as your edge in the market. And we're going to study some Greek. So very, very important to have your head around the Greeks. So we'll go through that in a little bit of detail. And we'll talk about strategy selection as well. All right, so just quickly, a little bit about me for those who don't know me very well. I started trading options in 2004. Spent thousands of hours researching, live, breathe, eat, and sleep the financial markets. I went back to school in the late 2000s, ended up doing a master's in applied finance and investment, but really hasn't really helped me much at all, that master's. It's really the experience in the market is where you learn. So I've authored 5 books, actually now 7. 5 of them were bestsellers on Amazon. So my first trade was a put option on a retail stock. The main reason I entered the trade was because it was cheap. So the put option only cost me $200, and I figured if I lost it, then it was no big deal. I owned some stocks and mutual funds, or ETFs, I guess, for the Americans. And I figured if my stocks went down, my main portfolio went down, then I'd make money on the put option if that happened. So this was back in 2004. And as you can probably guess, I suffered 100% loss on that first trade. It was a good lesson. My stocks went down, and the retail stock that I owned the put option on went up. So like I said, a good first lesson. I kind of lost on both sides of the trade. From there, I started learning about credit spreads, iron condors, and other option strategies. I was really excited and was sucking up as much knowledge as I could from any source I could find. Read countless books, blogs, attended webinars, etc. All the things you have probably been doing as well. I had some success early on, but really I was just a bull market genius. Might have heard that saying before. The massive bear market from late 2007 to early 2009 was another eye-opener as I took some big losses. I made every mistake in the book, and maybe you guys have made some of these in your time trading. I'd have a good winning streak, but then I'd give it all back with one bad loss. I struggled to know when to enter, adjust, and exit trades. I chopped and changed from strategy to strategy. I didn't cut losses early enough, so it was more of a hold and hope kind of thing, which is a terrible way to do things in the market. And I was not disciplined. So some of those mistakes that maybe you've been making as well. My first aha moment came when I realized that making money in the markets is actually incredibly easy. Any monkey with a dartboard can make money in the markets. What is much more difficult is avoiding big losses. Everyone has heard the saying, cut losses early and let profits run, but how many of you actually apply it? So I became ruthless with cutting losing trades. If something wasn't working, I simply closed the trade and moved on. I couldn't allow losing trades to affect me emotionally. Managing losing or difficult trades expends a huge amount of emotional capital. It might mean that you miss other opportunities because your focus is clouded by that trade that's under pressure. Risk management and trading psychology is ultra important when trying to become a successful trader. My second aha moment was realizing that consistency is the key to success. To become a successful trader, you need to have a consistent set of actions. You can't constantly hop from one trading method to the next. You need to plan your trades, manage your trades, and review your trades via a consistent set of actions. My third aha moment came when I realized how important patience is in the market. Early on, I felt like I always had to be in the markets, always had to be doing something. Now, I prefer to be in the markets less and wait for those perfect opportunities. There will always be opportunities, and if you can be patient and wait for the most high probability setups, it will make a massive difference to your trading. So take the last month or two, for example. I've been out of the markets a lot because the market's just been going a bit too crazy, right? So I'm waiting for things to settle down a little bit. There's no need to be trying to force things in this kind of market. All right, so that's a little bit about me. So let's move on to step one, and that is avoiding these two mistakes. So options trading offers much more flexibility than just trading stocks. You can make money if a stock goes up, down, or sideways, which is what I love about it. Some newbies get sucked into the idea of making a quick buck, and all the marketing hype that's out there doesn't help. Options can provide amazing leverage, especially out of the money options. Who wouldn't want to control 100 shares of stock for only a few $100s, right? Yes, buying out of the money options can make significant gains. The problem is you have to be spot on in terms of both direction and the timing of the stock movement. As you know, this can be quite hard to do. To make a profit, the stock needs to move in your direction and do it quickly. Time decay is not your friend. Let's assume you're bullish on Apple when it was trading at 115. You look at those, the $130 call, so out of the money, and you see you can buy a 30-day call option for $40. Okay, so that's $40 total. Seems very cheap for exposure to 100 shares of Apple, right? And yes, it is. So much so that you decide to buy 50 of those calls, which cost you $2,000. So 50 calls represents control of 5,000 shares of Apple. And you think to yourself, wowzer, if Apple rallies big, I'm going to make a killing here. Apple hits $135 later in the month, or if it does, you could be in line for a $25,000 payday. If only it were that easy. So $25,000 on a $2,000 investment is a 1,150% return. Not bad for 30 days, right? At first glance, that kind of leverage is amazing, but don't let the big numbers fool you. You need Apple to rally over 17% in 30 days for this to happen. You need the stock to make a 2 standard deviation move in 30 days, not something that happens very often. I'll get more into standard deviation shortly. Based on probability, there's a roughly 8% chance that this would happen. In all likelihood, the options will expire worthless and you will lose 100% of your investment. Okay, it's basically what happened to me with that put option. So in order to profit with out of the money options, you need to seriously outwit the market, have insider knowledge, or just plain get lucky. A better approach is to use probability in your favor and be the casino rather than the gambler. And we'll talk more about that in step 2. Mistake number 2. Having a written down trading plan will put you ahead of 80% of the other traders out there. So shoot me a message. Let me know if you have a written down trading plan, not something that's in your head. Be interested to see how many of you actually have a written down trading plan. Unfortunately, most newbies don't have one. It's either in their head or worse, they just make it up on the fly. And that's a lot of what I was doing in those early days as well. Getting into a trade is the really easy part, okay? Knowing when to take profits, when to adjust, and when to exit is much, much harder. And not just when to adjust, how to adjust as well, very important. Emotions can get on top of you in this game, and when they do, you're toast. The market will eat you up and spit you out. Having a written down trading plan helps take the emotion out of the equation. You'll have a plan and know exactly what you're going to do no matter what the market throws at you. You can also refine and develop your trading plan as you go along. Keep good records of your trades. Who does that? Who keeps really good records? That way you can analyze what's working and what isn't. And you can then adjust your plan accordingly. You should have an overall plan covering things like exposure levels, position sizing, eligible stocks, maximum number of trades, etc. Okay, so that covers your overall plan. And then you have a trading plan for each specific option strategy you're going to trade. You can download a sample from that link there, optionstradingiq.com/Condor plan. Some of you may already have that. Okay, that's an example of how you set up a trading plan. Okay, so it sounds like a few people have got trading plans, a few people don't. That's fine. Who reviews their trades? Let me know in the question box there who reviews their trades periodically. Usually I put them into Excel, have a nice little trade tracker. Again, I can give you guys a copy of that if you want, if you don't have it already. And then every month I'm reviewing what happened over the last month, what trades worked, what trades didn't, what could I do better. All right, so having a trading plan and a review. Okay, so that's great. A few people do that already, which is awesome. All right, step number 2 in our blueprint is using probability. Using probabilities in your favor is the best method for options trading success. You should aim to generate consistent income rather than looking for home runs via out-of-the-money options. Typically, broad markets trade in a sideways manner the majority of the time. It's been said that 80% of options expire worthless. So would you want to be a buyer of options? Probably not, right? Market makers know that buying out of the money options is a fool's game. So they tend to trade from the sell side. Why? Well, it's all based on probabilities. But don't worry, you don't need to be a math geek to understand it. Market makers use mathematical models to determine the price of an option. Knowing the likelihood of a stock reaching a certain point allows them to set a price based on that probability. There's a lot of computers that will do all these calculations now. Back in the 80s and maybe early 90s, this was all probably done manually. But a lot of this is just automated now, and a lot of brokers have all these tools, which is great. Makes things a lot easier for us these days. It's probably one of the best times ever to be an options trader because there's just so much information out there and so many great tools. One of the issues can be perhaps information overload. There's just almost too much information. So here we see a normal distribution or bell curve. You can see that the majority of the time, prices are going to fall within this 2 standard deviation range. Okay, now it doesn't quite work exactly this way in financial markets because we have these things called fat tails where we get these sort of 2 to 3 standard deviation moves, on the downside a little bit more often than what is implied by the normal distribution. Okay, but this is the general idea that the majority of the time we're within this 1 to 2 standard deviation range. As I said, a lot of brokers these days will have tools available where you can put in the price of a stock, you can put in the implied volatility, and it will give you the predicted range based on the probability. So you can see here we've got a stock that was trading at about 110 or something like that, I think 115. You can see the target price on the downside was 98, on the upside was 130. There's only a 3.5% chance it would finish above that level and a 2.24% chance it would finish below. Okay, And here's our standard deviations here. 1 standard deviation, 2 standard deviations on the downside. So you can see that 98 level is a 2 standard deviation move down. Fairly unlikely to happen. Same as the 130 on the upside. Using probability analysis gives traders a very useful tool for determining price targets to trade against, and they are free on most platforms. You can also use delta as a quick estimate. All right, so if you're trading a 5 delta option, it's not exact, but you could say there's a roughly 5% chance that that option will finish in the money. So again, if you're buying those options, very, very unlikely that you're going to make a profit. Majority of the time, that's just going to expire worthless. Volatility is an extremely important factor to understand when trading options. This is step 3, using volatility as your edge. So if you can master volatility, you'll be ahead of 90% of the other retail traders out there. There are 2 types of volatility. So historical volatility, and that's a measure of how much the underlying asset has been moving in the past. So that's a known number, okay? Implied volatility shows the expectation of future volatility, and that's an unknown. This is really the only unknown in the options pricing model. So we know the strike price, we know the current stock price, we know interest rates, we know when the dividends are. The only piece that we don't know, or that we have to guess, is implied volatility. So this is really the most important piece when it comes to trading options. If your estimates of implied volatility are better than other traders, then you're going to come out ahead. So just like a stock, you want to sell volatility when it's high and buy when it's low. Okay, so here's an example we can see here from Google. The yellowish line is implied volatility, and the blue line is historic volatility. Okay. So the most important one for us is the implied volatility. We want to be selling options when implied volatility is really high. So you can see here in late or mid-October, implied volatility was very, very high. A good time to be selling options. Then you come forward to the end of November or this time in August, volatility is very, very low. That's a time to be buying options in Google. Okay, if you did some delta neutral trades here at the end of November and you were hedging your delta and just taking exposure to volatility on the long side, you would have done really well because volatility spiked up here. There's also a kind of known factor when it comes to earnings. So implied volatility gets bid up into the earnings announcement because there's a big unknown, and stocks tend to move quite a lot after the earnings announcement. So you can see here earnings 4 times a year. So there's probably an announcement here in April, a really, really high implied volatility, and it drops up after the announcement, slowly goes down, gets bid back up, leading into earnings, probably earnings again here in July, and October and December. These are probably all earnings. So I can give you guys examples of how to do that and stay delta neutral. Is a strategy called a gamma scalp, which is a really good one, bit of an advanced trade. But this is really, really important to have an understanding of this. And if we look at this chart, if implied volatility is lower than the realized volatility or the historic volatility, that's a really good time. This would have been a really good time for condor traders, things like that. And you can get this from ivolatility.com. It's all free. You don't need to sign up, I think, or maybe you need to give your email or something like that. But I use this really regularly in my trading. Okay. There's another concept called implied volatility rank, which is a really good one to understand. So when implied volatility is up here around 37%, it would have an implied volatility rank of about 100. It's basically the highest it's been in the last 12 months. And then down here, when it's at about 16, it would have a really, really, really low IV rank, because it's the lowest level of implied volatility we've seen in the last 12 months. So that's an important concept. There's another really good tool. I haven't got a screenshot here, but again, it's a free one. They do have some paid products, but I usually just use the free stuff called Market Chameleon, which is a really good one. I'm checking that regularly. They have some good screeners there for IV rank. You can look for stocks with elevated volatilities, and stocks with very low volatility. So that's a really good one. All right, so here's a theoretical example to demonstrate the idea. Let's take a stock that's priced at 50 and we'll consider a 6-month call option with a strike price of 50. If implied volatility is really high at 90, the option price might be about 12.50. If implied volatility is 50, the price might be 7.25. And if implied volatility is 30, the option price might be 4.50. So you can see high vol equals high price, low vol equals low price. So we want to be buying when vol's low, we want to be selling when vol's high. Does that all make sense? All right, I see some good questions coming through. I might leave those to the end and we'll get to those. And we'll keep going. We'll do some Greeks. We might cover some of these anyway as we go along. Okay, so step 4 is to study some Greek and have a really good understanding of the important Greeks. So these are risk measures that can help you choose which options to buy and which options to sell. You can also use them as ways to determine adjustment points and things like that. So with options trading, you must have an idea of the direction of the underlying as well as a view of the direction of implied volatility and then factor in the timing. So the Greeks help you tailor your strategy to your outlook. Understanding the Greeks gives you even more of an edge in this zero-sum game of options trading. Delta is the option's sensitivity to changes in the underlying stock price. It measures the underlying price change of the option given a $1 change in the underlying. So if you've got a 50 delta call option, the stock goes up by $1, the option price is going to go up by 50 cents, okay? Same if you've got a delta of 20 on a call option, stock goes up $1, your option price is going to go up by 20 cents. Vega is the option's sensitivity to changes in implied volatility. A rise in implied volatility means a rise in options premium, and so will increase the value of long calls and long puts. And that's assuming there's no change in the underlying stock price, just volatility going up. Both the puts and the calls are going to go up in value. And Vega also increases with each expiration further out in time. So if you're going out further in time, you might have a higher exposure to Vega. And Theta, so what we're all trading for, time decay. It's the option sensitivity to time, and it's a direct measure of time decay, giving us $1 decay per day. And Theta increases exponentially as you approach expiry. So I'll explain a bit more about those shortly, but let's take a look at this time decay graph. You might have seen this one before. So basically you can see here that the closer we get to expiry, the faster the option prices decay. The trade-off is that you've got a lot of price risk, a lot of gamma risk. Okay, I won't go into gamma too much because it's kind of the most advanced Greek. But yes, you get a lot of time decay in this last week, but you also have a lot of price risk. I tend to stay away from the weekly options. A lot of people get sucked in thinking, you know, the huge amount of time decay in this last week and they want to capture that time decay, but they don't understand some of the other risks that go along with trading that way. And, you know, I can't tell you how many times I've received emails from people saying, you know, I was trading these weekly options, weekly condors and credit spreads, everything was going great, making money every week, and then all of a sudden, bang, you get a big move in the stock or the index, and, you know, they wipe out 3 months or 6 months worth of gains, you know, in a couple of days. I've just seen it happen so many times, and I tend to just stick away from that now. As I said, you know, that's too high risk for me. Yes, the returns can be really, really high, but the potential losses can be high as well. You know, I tend to prefer to trade further back on the curve. And even these days, I'm going as far out as sort of 120 days and 90 days trading on this part of the curve here. Yeah, you've got much less time decay that you're picking up, but the trades move a lot slower as well, which is great for me not wanting to be in front of a computer all night. So even with a big move in the underlying, you know, I might be able to wait 2 or 3 days before I need to make an adjustment. Whereas, you know, someone who's trading, say, a monthly option, they'd have to adjust straight away. And someone who's trading a weekly option, there's really nothing you can do, to be honest. It's almost impossible to adjust those when the stock makes a big move. So that's what I prefer to do. I prefer to be trading out here, you know, anywhere from sort of 120 to 60 days. Usually if I'm opening a 60-day trade, I'm closing it out when there's about 30 days to go. All right, so never take options into that last week. The only slight exception to that might be, if I've got a really wide iron condor that I've had on for a while, the stock's right in the middle, and there's a very, very low chance that anything's going to happen, I might take it into expiry, but very, very rarely would I do that. It does cost you to close them out. You have to pay a bit of the spread. You have to pay some commission sometimes. So sometimes you can hold them if there's very, very low risk, but typically I'm not doing that. As I said, I'm trading more on this anywhere from sort of 120 to 30 days on the curve. Does that all make sense? Cool. All right, so gamma, as I said, it's a bit more of an advanced Greek, but it is still important. I won't go into it in too much detail, but it's the sensitivity of the delta to changes in the price of the underlying asset. So gamma measures our change in delta for a $1 change in the underlying. May not make a lot of sense, but the main thing to remember from this is that short-term trades have really, really high gamma risk, it's basically just how quickly does the price of the option change based on the price of the underlying moving. So really high gamma risk in that last week, further out on the curve. Again, really, really low gamma risk. So again, that's part of the reason why I prefer trading further out. And rho, we don't worry too much about that, but it's basically the option sensitivity to changes in interest rates. And as I said, most traders have little interest in this measurement, particularly if you're trading, unless you're trading like leap options, really, really long-term options, changes in interest rates aren't really going to have a huge impact on option prices. All right, step 5. So there are literally hundreds of ways to trade options. Over the long haul, income trading provides one of the best opportunities for generating consistent profits. Every trader should master 3 to 4 income strategies and select the best one based on their trading style and market outlook. Okay, so I typically stick to no more than about 6 to 7 strategies. Okay, and I won't be trading them all at the same time. So if you can master 3 or 4 of those to start with, and then slowly start to add in another 1 or 2, up to about 6 or 7 strategies, and then you should be good. You don't really need too much more than that. As I said earlier, you don't want to be chopping and changing. You don't want to be doing too many different things. If you can stick to these next strategies that I'm going to show you, you'll be in good stead. So obviously iron condors is the big one. That's kind of the biggest and best, forms the basis of most of our trades. It's also the best one to learn about options and Greeks and adjustments and things like that. Once you get your head around condors, all the other strategies become much, much easier. So other strategies, I'm talking about things like butterfly spreads, covered calls, or we trade the wheel strategy. You might have heard me talk about that. Diagonal spreads, strangles, you could say strangles and straddles, both on the long and the short side. And then another one that I trade is an iron trapdoor, which is a trade that I've developed. It's a variation on the condor. Basically, it's kind of like a lower risk version. It can handle up rapidly moving up markets much, much better. And it also has a huge profit zone on the downside if the stock does fall. So I'll teach you about that one if you want. So those are really the main strategies. Covered calls, again, fairly simple. You guys should hopefully understand that a little bit. What I tend to do is split my capital in half. So half of it will be what I call a long-term or investing strategy. As you know, markets tend to go up over time in the long run. So you want to have some exposure to the long side of the market in your retirement account, things like that. You're doing your dividend investing and things like that. So that's where I'll be using covered calls. So I'll be selling call options if the stock has a really nice run up and I want to lock in a bit of profits. If stocks have a big drop, I'll be selling put options, and if they keep dropping, I'll take ownership, collect those dividends, and sell call options against that stock. So that's the wheel trade. A bit more to it than that, but that's kind of the basic overview. And then butterfly spreads. I have a bearish butterfly trade that works really, really well in bear markets, so that's potentially going to be a good one for 2019. Condors again can work really, really well in high vol and low vol environments. The only time they don't work well is when implied volatility moves from low to high. So like we saw recently, the last couple of months, October, November, December was a tough period for condor traders because volatility was quite low. And then all of a sudden we get this big expansion in volatility. If you had condors open before that happened, that can be bad. But if you're putting on condors after the spike in volatility, that's a really good opportunity. So as I said, condors sort of form the basis, the main building blocks of a lot of these other strategies. Butterfly spreads I like to use, as I said, bearish butterflies, then also directional butterflies. So you can, if you've got a stock that you think is going up or down, you can place, rather than buying those out of the money options that are really expensive and decay really fast, we can put on a butterfly spread out of the money. It works really, really well. Then diagonal spreads work well. Part of that could be a poor man's covered call. You might have heard that term, where you're buying a long-term in the money option, a leap option, and selling monthly calls against it. That works really, really well. Then, as I said, strangles and the trapdoor. All right, so we'll just go through these quickly. So covered calls are a logical place for newbies to start. It's a simple step for those that are familiar with stock ownership to start trading covered calls. And the strategy involves owning or buying stock and selling an appropriate number of calls against it. It's a slightly bullish to neutral strategy. It can generate extra income in your account and potentially reduce volatility. The trade-off is giving up some potential gains. So you want to be trading this strategy not in the middle of a bull market when stocks are going really, really high, more towards the end of the bull market, stocks that you want to continue owning, but you're worried about going on a little bit of a drop, generate some extra income and help protect a little bit of that downside. So should be all familiar with option payoff graphs, I'd imagine. So pretty simple here. We're generating extra income, but giving up a little bit of the potential downside. And we also, by generating that premium, we can reduce our break even a little bit as well. So what do we do covered calls? Well, it's been shown, this was a study by Goldman Sachs, I think, that over the long run, covered call trading can outperform pure investment in the S&P 500. Yes, you have losing periods when stocks drop. That's a given because you're long stocks. You only get a little bit of protection from that covered call. But in the long run, according to this survey or study from Goldman Sachs, you do come out ahead doing covered calls. Again, provided you're methodical and you stick to a plan. Now, butterfly spreads are another good one. So they gain from stocks staying within a narrow range. Profits accrue very quickly near expiry, but P&L will move around a lot. So again, this is any strategy with that sort of tent shape has a high gamma component. So as you get close to expiry, again, that gamma risk increases again. As you get close to expiry, your P&L is going to fluctuate a lot. So again, sometimes with butterfly spreads, going further out in time just reduces that P&L fluctuation that you might experience from day to day. Trades move a bit slower. You can take a bit more time adjusting. That's great for people who are still working full time. They can't be stuck in front of a computer. They're called into meetings and things like that. They can't be adjusting trades, throughout the day. That's a good thing to do. Spreads can sometimes be wide on butterfly, so that's the bid-ask spread because you're trading 3 options in the one trade. So traders should be aware of this when entering and exiting trades. So you want to trade highly liquid instruments to try and reduce the amount of bid-ask spread that you're suffering. And directional butterflies are a cheap way to gain directional exposure on a stock. So that's something that I really like to do. If I want to protect the downside, rather than just buying a put option, which is very, very expensive, and then you end up losing it all if the market rallies or doesn't drop. You buy an out-of-the-money butterfly instead, which is a lot cheaper. Maybe sometimes it can be sort of 10% of the cost of a put option, and you've got this nice profit zone that you can structure 5% or 10% below to give yourself a little bit of protection. So there's our butterfly spread, pretty standard. So again, that would be sort of an at-the-money spread with the stock at 100, but maybe the stock was trading at 110. You wanted to protect against a 10% down move in the next couple of months. Now that's a really nice trade. Only cost you a little bit. You've got a nice potential profit if it does drop to 100. Another thing I like to do that can work really, really well, and this is again, a way to protect against a big move early on in a trade. So sometimes when you put on a trade, if you guys ever experienced this, you put on a trade and then the very next day the market moves like 2%. It happens. It's trading, right? But it can be quite annoying. So what I do sometimes to give myself a little bit of protection against that happening, I call this a weekly double butterfly. Okay, so this is the only time I'd trade weekly options, again, because I'm not risking much, okay, in comparison to the potential profit. So I might put on my Condor trade, and then I might say, right, this butterfly expires in 4 days. I'm going to protect against a sort of 2.5% move either way. Okay, so that can work really, really well. I had this one time on the S&P 500 where I put one of these on, and the S&P 500 closed almost right at the peak of the tent. Very rare for that to happen, right? But that was fantastic. And a lot of times with those indexes, you might have heard of the concept of pinning a strike. So you find that the S&P 500 at expiry, it tends to be drawn, I guess, to those 25-point strikes. So you can go back and look at those key option expiry dates, and a lot of times you'll find the S&P 500 closes at 2550 or 2575 or 2600. So you can structure your trades like that to try to capture that concept of a pin. So that's something, again, a little strategy that you might like to incorporate into your trading as a little bit of a protective measure. So iron condors, as I said, these are fundamental, or the fundamental option income trade. And this trade profits from stocks trading within a defined range. They provide a great way to take advantage of spikes in volatility. So like recently, big spike in volatility, potentially a good time to enter condors. The one thing that you need to be careful of is V bottoms. Okay, so that's one thing you've got to watch for. If the market's had too much of a drop and volatility's gone really, really high, you might think, great, volatility's high, option premiums are high, but all of a sudden you get this V-shaped reversal, and pretty quickly you're under a lot of pressure on the upside on your condor. So, sometimes when volatility spikes a lot, it's not the best time to enter a condor. You want to wait a few days for things to settle down. Volatility is still high, but it's come back a little bit, and you're not going to suffer that V reversal quite as much. Another thing to look at, and I can send you guys a short video, just 2 or 3 minutes, but it's contango and backwardation. Again, it's kind of an advanced concept, but really, really important. It's basically the futures curve of volatility. So the expectation of future volatility, normally that rises over time when we get into a period. So that would be called contango. That happens sort of 90% of the time. That's sort of a standard market. Then when we get these market panics, we move into what's called backwardation. Bit of a funny word, but basically what that means is short-term volatility is really, really high and it falls off into the future. Okay, so it's the opposite of what we would normally see. The expectation is, yes, the market's in a bit of a panic right now, so we've got really, really high volatility right now, but 3 months, 6 months into the future, things are going to settle down, volatility will come back to normal. So contango and backwardation. And another key thing when getting into condors, a lot of times when we get these big spikes in volatility, we get into backwardation, the market's a bit irrational. It's not a great time to be doing condors. Sometimes the best time to get in is when we move from backwardation into contango. Okay, it's kind of a sign that the market's going back to a more normal environment, and that can be a really good way to pick your entry points. So I'll send that video if you guys are interested. Again, pretty much explained it now, but you'll see it visually as well with some examples. So iron condors are high probability trades that are easy to manage once you have some experience. Again, standard payoff graph, this is what we're trying to accomplish. We've got a high probability of success because we've got a really big range. The trade-off is we're not generating that much income in comparison to what we're risking, but we hope to achieve sort of at least a 70% success rate on condors. All right, diagonal spreads are a cross between a calendar and a credit spread. So a calendar spread and a credit spread is kind of a combination. They're positive vega. Traders want the short option to expire worthless, leaving them with the long option that they can choose to hold or close. So again, this can be a nice way to hedge some of your condors is by having diagonal spreads, because they're positive vega, right? So if you enter a condor and then all of a sudden we get this big volatility spike, it's bad for your condors. But if you've got a couple of diagonal spreads on, those trades are going to benefit from the rise in volatility. So here's what that might look like. We can structure it on either the upside or the downside. It's somewhat similar to those butterflies where we're creating this big profit zone above or below the market. Here we're trading it on the call side. Got this really nice profit zone. It's kind of zoomed in so you can't see the risk, but the risk is on the upside. So if it does rally really quickly, that can be bad. We want it to kind of rally slowly and end up in this profit zone. And we've got sort of very little risk on the downside. You can do what's called a double diagonal as well if you want to protect both sides. Similar to what we did with that butterfly, we could have another diagonal here on the downside. Again, it's just creating those zones where, what's going to hurt us with our condors? It's going to be a move up to, this area in the next few days or weeks, or a move down to 130. So we'd create another profit zone here with a put diagonal. So that's how we protect against those big moves. And another way is through long and short strangles. So short strangles are risky because they have unlimited risk, so naked options. So not for everybody, particularly beginners. So keep that in mind. They can have a place in your portfolio, but as I said, beginners should avoid them. Long strangles, on the other hand, can be a great hedge for your core trades. So similar to those diagonals, these are long volatility trades. So if you've got your core portfolio of condors and volatility is really, really low, but starting to pick up, you're worried about a big vol spike, long strangles can help hedge that risk a little bit, okay? If the market makes a big move, it's going to hurt your condors, but the gains on the long strangle will help offset that. Long strangles should be entered when implied volatility is low and when the underlying has had a period of consolidation. So this is something I talk about a lot. If you look at pretty much any chart, I actually haven't got an example here, which I should have done, but stocks go through periods of consolidation and expansion. It's pretty much as guaranteed as death and taxes, right? If a stock goes through a long period of very small price movement, chances are there's a big move coming. And, same on the opposite side. Stocks go through this period of wild volatility, big moves up and down. That doesn't last forever. After that sort of period comes a period of consolidation. So you want to be looking for doing to do long strangles on stocks that are consolidating or have been consolidating for a while. Volatility is really, really low, and you want to be doing condors on stocks that are going through a big period of expansion, and they're probably going to settle down over the next couple of months. So that's how you kind of balance your portfolio a little bit. Then we can get into some more advanced trading. So this is the trapdoor trade I was talking about. As I said, a variation on the condor. We've got much less risk on the upside. We only trade a couple of contracts on the upside, and we also buy a debit spread here, which gives us this large profit zone. So it's an advanced trade, quite a few moving parts, but it moves a lot slower than a condor. Okay, so you might find with a trapdoor and a condor, we often compare the two, and then if the market makes a big move, the condor is under pressure, it's hitting our adjustment points, but the trapdoor isn't. So that tends to happen a lot. So this is a really nice trade, particularly in bull markets, because a lot of times, maybe this is not going to be the best trade for next year, whereas the bearish butterfly might be the trade for next year. But over the past few years, this has been a really good trade to handle those periods in the market where it just grinds higher. A lot of people, when they first hear about condors, they're worried about the downside. They're worried about these market crashes, and that's fair enough. That can be bad. But most people over the last few years have had trouble on the upside because volatility has been quite low. Stocks have just been continuously grinding higher, puts the calls under pressure. So this sort of trade handles that move a lot better. And then you've also got the potential that it might drop down into this zone and you get this even nicer profit that you've built for yourself. So that's the trapdoor. Again, we can go into some more of this stuff next week. There's a bit of an introduction today. So thanks for attending. I hope you got a lot out of it. Shoot me through any questions on email. I know we've got a few questions here, so I'll go through those now. Feel free to stick around while I answer those. And any other questions, shoot them through. If you think of anything afterwards, just email me info@optionstradingiq.com. So question from Lucy, I reviewed the Condor trading plan. I was troubled with the delta dollar exposure. For example, if delta dollar exposure reaches plus or minus 80,000. All right, so we can cover that probably a little bit more next week. But basically, that's one of the rules I have for Condor trading. We touched on the Greeks a little bit today, but basically, let's say I've got a Condor that is risking 40,000. Okay, now not everybody's going to have a position that big, and starting out, you probably shouldn't risk more than about 10 to 20% of your capital in Condors till you kind of get the hang of it. Well, even better is paper trade first, right? Then just slowly start with sort of 1 or 2 contracts, keep it small, figure out the mechanics, and then start to build from there. But in that trading plan example that you're talking about, sorry, is it Lucy or Lucky? Anyway, let me know. Basically, that was Lucky. Sorry, called you Lucy before, misread it. Basically, if we've got a $40,000 Condor on and our delta dollar exposure, and I'll explain delta dollar maybe next week, it's probably the most important metric that I use in my trading. If that exposure gets to double what the capital at risk is, that's my adjustment point. So that's basically how that rule works. If you've got a Condor that's trading $10,000 max risk and delta dollars gets to 20,000, that's your adjustment point. Okay, so fairly simple. But again, it's just understanding that delta dollars and how we calculate that, which I can go into next week. Do I use IB? Yep, use IB. It gives IV and HV. Yep. Yeah, exactly. So whatever you prefer, really. Lots of ways to get implied volatility and historic volatility these days, and IV rank, things like that. So whatever you prefer. Yeah. Do I like to hedge the call side of an iron Condor during low volatility? Yeah, so I'll be using some of those strategies I talked about in terms of diagonals and directional butterflies to hedge, depending on what my view is of the direction of the underlying and also what's going to happen, what I think is going to happen with volatility. Is it going to go up or is it going to go down? Yep. Is there any correlation between higher volatility towards the expiration dates of the options? Yes, so that's kind of the concept of contango and backwardation that I was talking about. And let me see if I can give you an example. All right, I will send you that video, but I'll also just explain it now as well. There's another good website, just dragging over here, vixcentral.com. Again, you can get this for free. This shows us the VIX futures term structure, okay? So what does that mean? Well, it means just basically what implied volatility is for the S&P 500 over the next few months. So the January options at the moment, you can see, it's really annoying this thing pops up, but anyway, at the moment we've got high volatility. We're in a period of not really market panic, but it's not really a normal market. I think you'd agree, right? So this is backwardation, where short-term volatility, January, Feb, is much higher than long-term volatility. So this is backwardation. It's not the norm. We might see this like 10% of the time. If I can go in here, historical prices, let me, how do I add an extra date? Here we go. Let's say we go to just before market started turning down. Might even go a bit further back than that. Let's go back to earlier in 2018. That'll be much better, I think. Okay, so this is contango. This is what you're going to see most of the time, where short-term volatility is low, longer-term volatility is high. The reason longer-term volatility is high is because we've got longer in duration. There's more chance that something bad can happen. All right. Whereas if we go to today, well, we add today. There we go. If I think I can turn that one off. Okay, so this is today. We're in backwardation. Expectation is, yes, volatility is high at the moment, but we think it's going to decline going forward. This is another reason why I prefer trading out here as well, because you don't, you're short volatility when you're trading condors, you don't get this massive spike. Trying to think of the date, or I might even have it somewhere else. Let me just see if I can find it to give you a good example. Not seeing it. Anyway, it'll be on that video that I'll send to you guys. Here it is. All right, here's probably one of the most extreme examples you're going to see. This was back in early 2018. I don't know if you guys remember. There was the whole volatility blow up that the XIV, ETN, and SVXY basically lost, went out of business. Volatility spiked 100%. It was the biggest vol spike we'd ever seen. Now it only went from sort of 15 to 30, but it was still 100% in percentage terms. It was the biggest we'd ever seen. So you can see it perfectly here. Feb 1st, we're in, it's hard to tell, but we're kind of in contango, kind of normal. Then we get this massive volatility event. Short-term options, the volatility has just gone through the roof. Whereas if you go further out in time, the volatility impact hasn't been as big. So again, those people who are trading the short end of the curve, those weekly options, and even the 30-day options, look at that, just got crushed. Whereas me being out here, yes, volatility's gone up. Yes, it, impacted my trades, but not nearly as much as here. Volatility here on the weekly options has gone from about 13 to 33. Massive. But out here, we've gone from sort of 15 to 19. So in percentage terms, not nearly as big of an impact as this. So, that's a really important concept. Hopefully that answered your question. So yeah, typically further out in time, volatility is higher, except when we're in backwardation, because the expectation is, yes, we're going through a bit of a panic now, things will settle down in the future. Cool. All right, guys, I really enjoyed today's session. I hope you did too. I hope you learned a lot. I'll send the replay out. If you guys want access to the slides, I'll provide those as well. Otherwise, any questions, shoot them through on email, and we'll meet again sort of same time next week for the second session. Excellent. Thanks, guys. I'll talk to you soon.